Hey guys, Jason here from SMYD Accounting and Advisory. Now today I am going to dive in and we're going to show you a bit of an illustration about something that is incredibly important in today's environment that we're operating in. With inflation, prices and all sorts of crazy stuff going on, it is so important that we understand our cash conversion cycle. Now rather than me sit here and try and explain it to you, we're going to jump into the screen here and I'm going to show you in a diagram exactly what the cash conversion cycle is and how you can work it out for your business. Now you'll see on the left at the very top we've got the average stock holding. So therefore that is how long is our stock sitting there as stock where it's not actually being converted into cash. The second part is the accounts receivable days. So we bought something, we've now sold it. How long does it then take for us to convert that back into cash? So you'll see as an example here, on day 0, we buy the stock from our supplier. On day 35, we've now paid the supplier for that stock. So on day 35, that's when the cash has gone out of our business. We then hold it for another 30 days. So on day 65, we sell that stock to our customer. And then our accounts receivable terms aren't that great, so it takes them 45 days to pay us. So on day 110 days after we buy the stock from our supplier, we receive the payment for that customer with hopefully a really good margin. So what we want to work out is what is our cash conversion cycle. The first thing we do is we take our average stock holding days plus our average receivable days. And in this instance here, you saw that our stock holding days was 65 days. And then our average receivable days was 45. So we add them up to get our 110. We then subtract off that the payable days. So how long was it between us ordering the stock and actually paying for it? Because as you know from our stock holding days, yes, it was 65, but we didn't actually pay for it until 35 days after that. So we take that off. Then that leads us with the magical number of the number of days it takes for us to convert something into cash. In this instance here, it was 75 days for us to convert that product that we purchased into cash. That 75 days is the bank of your business. Now we better hope that we're selling either enough of those products or we're selling them at a high enough margin that when that cash comes in, it can sustain another 75 days of cash lockup and pay for our overheads and also provide enough for our business to take out a salary. Because if that cash conversion day is too high, then that is going to be a key cause of cash stress within our business right now. So hopefully the cash conversion cycle there made sense. As I said in that example, it can be a huge cause of stress for our business and we absolutely, utterly need to know what that length of time is and if there's anything we can do to shorten it. Because the shorter the length of that time, the quicker we're getting cash coming in at the margin that we need for it to then cover and pay for our costs. So if this is something you'd like to understand and you think you'd need our help, please do get in touch with us at SMYD Accounting and Advisory, because we'd love nothing more than to sit down with you and help you understand this and start making some positive changes in your business.